Hi, my name's Tim Deason. I've been a B2B founder myself, and now I work with early stage startups to help them get first traction and first investment. Today I'm going to be talking about the fundraising journey. Some of the key fundraising stages for a startup are pre-seed, seed, and Series A. It's really important as an angel investor to understand what these mean. For pre-seed investment stage, founders typically don't really have a product or revenue yet. They're just looking for investment to help develop their idea. At seed stage, they'll often have some sort of traction, some early stage product and revenue to show. And at Series A, you're really looking at institutional investors. So that's often venture capital. They're raising much more significant amounts of money, and you'll really have some strong traction that you'll be able to see as an investor. For angel investors, we're typically looking at pre-seed and seed investments. It's very rare or kind of unusual that you'll be investing alongside Series A funds. What's really important for angel investors to understand is that fundraising never happens in isolation. It's a sequence of raises, and what the next investor is going to be looking for is just as important for you to understand as what you're looking for in a fundraise. Often there'll be 3 or 4 or 5 raises during the lifetime of a company. Each stage, larger amounts of money and further traction will need to be demonstrated. At the earliest stage, obviously we don't have any traction or product to kind of look at, so we're often focusing on things like team and strategy, which means it's less of an analytical evaluation and more of you developing your own idea about what the potential of that startup might be. One important term to understand is traction. For consumer startups, that will often be growing usage. For B2B startups, it's often revenue is what's really important. For many startups, this will not necessarily exist at kind of pre-seed. Certainly from kind of seed stage and Series A, it's something that we'll be looking for. Angel investors are really, really critical to the success of an early stage company. It's not just the money that they'll be providing, but it's the knowledge and network alongside that capital. They're the allies, the friends, the people who understand how this fundraising market works, but often they'll be adding their own discipline or domain-specific knowledge. So that could be accounting, it could be related to the technical capabilities of the product or kind of marketing. Experienced angels will really be able to provide an insight into the kind of market norms, valuations, fair terms. So it's really important for you as an angel to both develop your network, but make sure from a founder's perspective that they have a good kind of broad range of angel investors, because that is what also helps kind of counterbalance some of the inequities that can exist in the power balance between investors and founders. If you're a first-time founder, you're just not going to have had that experience of fundraising, what's fair, what's normal. Experienced angel investors are able to bring that to the table and really make sure that founders get a good deal. And it's actually strangely in investors' interest to make sure that founders get a good deal, because if there's too much equity given away too early or on too low a valuation, it means the founders aren't going to own enough of the business later on in order to be able to keep fundraising. So that's something that later stage investors are going to really want to understand. Does this founder own enough of the business to have skin in the game and want it to succeed? So it's really important to actually make sure some of these terms are fair and equitable right from the beginning. Don't underestimate the human aspect of angel investing. Early stage founders are often under a huge amount of pressure and on a roller coaster journey building their dream company. We can often forget that, I think, as angel investors, and imagine that it's all about the numbers, the analytics, creating the right outcomes, creating the right pressure. But the more, in my opinion, that you can think of it as a really human journey that you're there to support someone on, the more value you're going to get out of that relationship as an angel investor, but also, of course, the more likely that that founder will actually be able to succeed. So don't forget the kind of human element, and don't forget that it's actually be someone that you would want to work with and support over that kind of whole journey. So don't underestimate also the fact that you need to have those values and that resonance with them over time. Fundraising timelines are a really important topic to understand as an angel. From a founder perspective, they'll be raising typically every 12 to 18 months. So that means they're going to spend a significant amount of their time, all of the time, fundraising. For you as an angel, you may hear about an opportunity and then not write that check for another kind of 6 months. Some raises in a kind of slow market can take a full year to actually close. So sometimes if you're coming in at the end of the round, you might be actually investing kind of very, very quickly, but it actually can take quite a long time. And this is also reflected in the amount of time that it can take to see a return on your investment. So most companies may not exit, so may not have that kind of capital liquidity event even for 5 to 10 years after your initial investment. So it's really important to understand that your cash is kind of locked up in that company over that whole period. And there's not really any way that it can come back until that company is either kind of IPO'd, so an initial public offering onto the stock market, or that it's actually been acquired by a larger company. So hopefully that gives you a better idea of the fundraising journey. I think some of the key takeaways I would highlight are it's a long, slow, patient game. These are relationships that you're building over time, possibly pre-investment. You might be speaking to founders for 3 months, 6 months, or a year, but your exit as an angel is going to often take, as long as a decade. So these needs to be companies and founders that you're really invested in emotionally, practically, financially for a long period of time.